it turns out that it's really important what the degree of risk aversion is in the economy. Because if investors are very risk averse, they definitely do not want to reduce significantly their standard of living in recession. So risk-averse investors, very risk-averse investors, will really try to smooth their income. In doing this, what they do is to drive the price of that Treasury bill even higher. And it kind of makes sense. If people are not risk-averse, if they're so-called risk-neutral, then they don't care. That recession next year, no big deal. It means I have lower income, and I'm willing to live with that if I can live. That's what a risk-neutral person would do. So there's no extra demand for the one-year Treasury bill. And the price will not change. So we're not going to see fluctuations in interest rates that are related to expected economic growth. But the more risk-averse the investors are, the greater the motive for hedging, the greater the motive to ensure that there are not significant fluctuations in the standard of living. The greater the action will be to create the type of investment portfolio, usually using bonds, that will ensure minimal volatility in the standard of living, minimal fluctuation. Now, why use bonds for this, or why use Treasury bills? They are the simplest way to do this. One thing about a Treasury bill is a remarkably simple instrument that is guaranteed by the government. You buy it today, you get $100 next year. Simple. You cannot say that for a corporate bond. You can definitely not say that for an equity investment. An equity investment, who knows what you're going to get next year? The value of the investment could be zero, or it could be multiplied by a significant factor. But a bond, you know what you're going to get. It's less risky. As a result of that, the expected rate of return on the bond is less. But this is really a unique instrument, as I said, and part of the reason it's unique and part of the reason that it's forward-looking is that it is so simple, that it is the price of $100 1 year from now. So it's very useful to look at these simple bonds and go through these examples, because it is the essence of what an interest rate is. So the economic meaning of an interest rate is important to understand before we actually go through and do all of the mechanics. The mechanics are sometimes overshadowing of what the true meaning of what we're actually trying to do. So in this course in particular, I prefer an understanding of the economic intuition behind every instrument that we examine. This is not the sort of course where you are presented with formulas and told to solve for this and solve for that without really thinking about what you're doing. This is the type of course that you need to understand the fundamental economic foundations of each of the instruments. And only after you understand that should you be going and doing the mechanics of the valuation. It turns out the lecture note goes through a lot of mechanics, but do not lose sight of the economic meaning of what an interest rate is.